Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Let's get a preview here of what we may hear from this Federal Reserve this afternoon. Dennis Lockhart, he's the former Atlanta Fed president, joining us from Atlanta, Georgia, via that Zoom thing. Dennis, thanks so much for joining us here. I guess the market's looking for a 25 basis point cut today. A, do you think that's what we'll get? And B, what kind of message do you think Jay Powell wants to get across today?
Well, I think it's almost a certainty that we'll get 25 basis points today. It would be a big surprise to everyone. So I put that aside. I don't think it's a question. The message coming out of this meeting will certainly describe the economy as strong, with the labor market cooling, but not abruptly cooling. Inflation coming down. I think you'll hear more of the same basic message that Powell has put out at previous press conferences. So it's sort of a steady as she goes. He'll explain that the committee believes that they can continue to cut rates through 2025, and he's not going to make much noise about the election. I don't think he'll say anything that suggests any reaction to it at all. In the short term, at least, the election won't have much influence.
We don't know yet the impact on the economy of the new president's policies. Does that call for a smaller rate increases in the future, or even a pause until we get more clarity?
Well, it wouldn't surprise me if they consider a skip, not necessarily a pause of putting the policy path on hold, but just a slowing of the process as early as January. I really don't expect that in December, although I would point out that in the September Summary of Economic Projections, there were 7 people who were looking to only 75 basis points this year in 2024. That's a constituency for skipping in December if they continue to hold those views. So I think a skip in one of the next 2 meetings, but more likely in January, would allow them to take stock of what policies are likely to actually be implemented and what changes they have in the outlook because of that.
Pretty big political event earlier this week. Dennis, how should the Federal Reserve, if at all, address it today?
I don't think they should address it at all today. The formulation of monetary policy is not a political or politically influenced policy setting process, and it's not as if he can ignore a question from the audience that brings it up. But I think what you'll find is Powell will stay very removed from anything that suggests a reaction to political events.
Does the Fed owe the markets any guidance?
The Fed, does the Fed owe the markets guidance? I think the Fed has been giving guidance that the direction of travel is in the direction of lower policy rate settings. They have to be indeterminate as to where that will end. They just don't know. That depends a good deal on how the economy evolves over the coming months and next year or so. So I think guidance has been given. I doubt that you'll hear much in the way of amplification of that or elaboration on that in this meeting. The direction is to a lower overall rate setting.
Dennis, again, the Fed cut rates by 50 basis points, and as you just mentioned, there's the bias towards more rate cuts, yet yields have moved sharply higher. Mm-hmm. Is that what's going on there for the average investor?
I think there are a number of factors at work, but probably the one that deserves the most attention is the markets increasing their discount or pricing in some concern about the fiscal outlook. Both candidates basically were likely to be sustaining or even increasing deficits. And the proposals that are out there from Trump's campaign appear to be net inflationary and conceivably net fiscally unchanged in many respects, if not worse. So I think what the markets are seeing is that the fiscal outlook, coming to grips with the reality of deficits and the rising debt, as of now at least, don't appear to be a priority, and they're pricing that into the longer-term rates.
May I ask you what you think the relationship should be between the President of the United States and the head of the Federal Reserve?
The President of the United States should stay out of trying to influence the Fed in the direction of monetary policy. The Fed should operate independently. I happen to have pretty strong feelings about this. I think it's globally a fundamental of good governance to allow your central bank to make its decisions independently. And the influence is simply in the nominations that the president makes for the board of governors and the chair. And after that, I think the setting of policy should be done independently with no interaction with the president.
Dennis, do you think, what's the risk here if you're the Federal Reserve? Is it inflation coming back? Is it the economy tilting into a recession? Where do you think the Fed is kind of focused here on that balance?
Well, I think they're focused on two things. Of course, as everyone knows, there's a dual mandate, so they have to pay attention to both employment and inflation. A stickiness of inflation at current levels, possibly a resurgence, which could be based on some policy decisions that are made in the Trump administration. So that is a concern, and a cracking of the good situation we have in employment markets today. I pay attention to initial claims. If you saw initial claims shoot up, it would suggest that people are being laid off and something is changing. So I think they'll keep their eye on both and try to preserve a rather good economy we have at the moment, and particularly a good employment situation.
Can I ask you, being there in Atlanta, what was the message that you interpreted was sent by voters in Georgia and Atlanta in particular, and how should that be interpreted in the formulation of policy, whether it be monetary or fiscal?
Well, it's maybe a little early to opine on what the message was from the electorate in Georgia. And Georgia, of course, was like many other states around the country where Trump carried the state and got the electoral votes from the state. I think one message is that higher prices as a result of inflation, even with the argument that inflation is declining, higher prices really do affect the thinking of the voter. And I think that was one of several factors that was not favorable to the Harris campaign. Prices rose during the hyperinflationary period we saw right after the pandemic. Inflation has been coming down, but the prices themselves have not been coming down. And that is a real constraint on consumption in many households. And I think there was, to some degree, a vote against that reality.
Dennis Lockhart, thank you so much for joining us. Dennis Lockhart, former Atlanta Fed president, joining us from Atlanta via Zoom thing. And when I think about Atlanta, phenomenal city. I've got to, just over my career, experienced the growth of Atlanta, having gone there for so many times and had a lot of investment banking clients there. Every single street is named Peachtree Street.
I believe Dennis's firm is on Peach Street, right?
Yeah,
Peach
and
Lane?
it's something like 36 streets have the word Peachtree in them, so it's very easy to get confused. And then there are a lot of other institutions that use the word Peachtree, so it's certainly a Peachtree crazy city, to say the least.
Dennis, thanks so much for joining us, former Fed president for Atlanta, Dennis Lockhart. Yeah, it's amazing. It's a huge city, cosmopolitan, global city. But you ask somebody, it's Peachtree, but it's Peachtree north, west, southeast, and it's street, it's avenue, it's this. And so before you had like GPS, you'd say, you give an address to a cab driver, 9 times out of 10, you take it to the wrong place because it's Peachtree Southeast you wanted. I was like,
and of course, home to Coca-Cola. Right?
Coca-Cola, yeah, it's an awesome town, but great stuff. And it's just been, I tell you, it's just been one of those. You talk about the growth of the Sun Belt, and Atlanta was the first. And just the dynamic growth just over the last 30, 40 years has been extraordinary. It's now, I think, like the 4th biggest market in the U.S. It's something huge like that.
It's on my bucket list. I haven't been yet.
Oh, dude.
I mean, I think I've been through the airport, but that was it.
Yeah, but the traffic is just brutal down there. It's one of those, again, the growth of the Southeast, these towns grow so quickly, the traffic, the infrastructure can't keep up. But anyway, getting the latest from Dennis Lockhart down there.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
All right, Matt Miller sitting in for Alex Steele. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. It is Fed Day. And after announcing what's widely expected to be a quarter-point cut in interest rates, the Fed will have to reassure markets it can manage the impact of a president-elect who's vowed a raft of new tariffs and tax cuts. What does that mean? Is Fed Chairman Jay Powell, did his job just get more difficult after Tuesday's political election results? Katerina Sarajeva joins us here, a Federal Reserve reporter from Bloomberg News. Katerina, did Fed Chairman Powell's job get a little bit more difficult given the presidential election results from Tuesday?
I think in a way, yes. I mean, of course, you will try to, steer clear of anything politics related in his press conference. And, when he's asked about it going forward, they always try to just remain apolitical. But I think the reality of a new administration is that we are likely to see some policies that may stoke inflation a little bit or even growth, right? It's not all negative, but it does mean, it may change some things for the Fed. And we've certainly seen that in banks, some of the Wall Street economists and financial markets kind of repricing what they expect for the Fed going forward.
So what do you think we're going to get out of today? I feel like it's going to be a pretty boring Fed meeting since they're locked in for 25 basis points, but they probably won't want to say anything about the next meeting, certainly not about 2025, right?
Yeah, I think that's right. I think today should be pretty boring. They're probably going to deliver what we're all expecting, which is that quarter point cut, like you're saying. And then it's not one of the quarterly meetings, so we don't get updated economic forecasts from them. So there's not kind of those extras that we would get at, that we got in September and that we'll get in December. And yeah, I think they're really going to want to leave the door open because we've had some economic data recently that has shown that things might be heating up a little bit again. So even outside of the election, we're seeing some strength in the economy that might have implications for the Fed. And then also we don't know what policies will be implemented. We're not going to have a new government in place until January. And then, these things take a while. So the Fed isn't going to want to kind of subscribe itself to anything that hasn't happened yet.
So what do you think we'll hear from Chairman Powell today as it relates to the election? Is it just literally say nothing, just dance around it, or just, I guess, kind of say, hey, we're apolitical and we're fine?
Yeah, I think that is, both of those is what we'll see, and we've seen that all year. This has been a big question for them. But yeah, they love to say, look, we have nothing to do with this. Our job is to react to what the economy is doing. Right? They'll say things like Congress has given us this dual mandate, stable prices, and maximum employment. What we're focused on. We're looking at the data as it comes in to figure out what we can do. And they'll probably repeat something that they've been saying this year as well, which is that policy is well positioned to address anything that comes its way. So we're kind of in they've started cutting interest rates already. We're in a position where if they need to cut more, they can do that. If they need to pause for a while, they can do that. So I think they see themselves as being kind of in a good place to be nimble and react.
Is policy really restrictive here? I mean, I'm looking at 6,000 right now on the S&P 500. Unemployment is at 4%. Growth is at 3%. I mean, what are they restricting with these levels?
Yeah, and we just got some really hot, earnings number, not earnings, like worker earnings numbers today. So yeah, I think that's been.
But Katerina, earnings also have been good, and we're expecting 14% earnings growth in Q4 and Q1.
Yes, yeah. No, I mean that's been the $1 million question all along, right? How are we restrictive? How restrictive are we if we are? How is that even being transmitted to the economy right now? I mean, we know, for example, with mortgage rates, a lot of people are locked into low rates, and it's not having the transmission effect that it normally would. So it's. I think that's an open question, and I do wonder if we're going to start hearing more chatter of, are they going to have to start hiking again if things get really out of hand?
Paul, you're not locked into a low mortgage rate.
No, I'm at 6%. And
are your refinance dreams dashed by Trump?
Dashed.
Yeah.
I mean, the rates just kicked back up here. All right, Katerina Saraiva, Federal Reserve reporter for Bloomberg News. Thank you so much for joining us there. Matt, before we let you go here and we go to Joe Matthew and Balance of Power, what are you driving?
Oh, actually, right now I'm driving So for those who don't listen regularly or watch my show, I drive a new car every week. So I'm always test driving a new vehicle for my podcast, Hot Pursuit with Hannah Elliott. Usually I'm in fancier cars, like maybe an Aston Martin or a hot new Mercedes, a lot of BMWs I like a lot. Right now I'm driving a Chrysler Pacifica minivan.
Ooh, how's that going?
It's a hybrid. I gotta say, I had never driven a minivan before.
You have 2 kids, so you should be in the market.
Yeah, and I've spent so many years and spent so much money trying to avoid going to the minivan. I get an SUV that functions like a minivan but still looks tough, and I feel like I've been wasting that cash because this is a pretty nice ride. I mean, it's not amazing, you know, but it's got the low load floor. It's kind of smooth sailing with the hybrid engine. It's pretty good.
See, there you go. Yeah, we were 20 years we had the minivan thing now. No mas. Katerina, thank you so much for joining us.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
John Tucker sitting in for Alex Steele. I'm Paul Sweeney. We are live here in our Bloomberg Interactive Broker studio. We are streaming live on YouTube as well. What does Donald Trump and the White House mean for big tech? Dan Ives joins us. He's managing director and senior equity analyst for Wedbush Securities. Dan, I mean, a lot of the questions for investors as it relates to big tech and the Trump administration is, I mean, what does it mean for big tech writ large? But I want to start with Tesla, because that's an industry that depends upon cooperation with the government. What do you think about Tesla?
I mean, for Musk betting on Trump, it might be the best poker move he ever made.
That's right.
And when you think about now, this is going to really catalyze autonomous, full self-driving. A lot of the regulatory issues that Tesla's been dealing with, I think essentially most of them go out the window here. Tariffs get pulled, which is negative for the EV industry, bullish for Tesla. Look, if you're a Tesla shareholder, for Trump getting in is basically a champagne moment. And I believe starts to unlock, we've talked about on the show, the $1 trillion of AI valuation now starting to get unlocked with Trump in the White House.
Yeah, just because of the jump in the stock yesterday, Elon Musk added $26.5 billion
He made a good trade
to his spot. So
He backed the right
yeah,
horse.
I guess it was a good trade. Can we talk regulation? What's the regulatory landscape going to look like? What does that mean for tech? How do you game that right now?
Well, I think the biggest thing, look, take any horror movie you want. That's really been what con's been to tech
Lena
companies.
Khan at the FTC.
So when you look at Con at the FTC, has really been that nightmare for big tech in terms of M&A deals, anything they do, and that's been an issue. That's been overhanging a lot of these stocks, not just Google, Apple, and some others. I think the view is heavy view that she's gone at the FTC, and that ultimately will let a much more friendly deal environment for tech.
But that doesn't pertain to Europe, though. Or does it? I mean,
Sure. Now, in Europe, big tech, I mean, they're used to fines are almost like cups of coffee there. So they're always going to get that from Brussels. But the big issue's been, Lena Khan from FTC has really been the big issue. With her looking to be out, that's another part of this rally here, because I think what it's going to do is going to be a tidal wave of M&A. You're going to see big tech. You still have DOJ and some other issues, but you see them more aggressive from an AI perspective. And this is really what tech investors want to see. Less regulatory, and then we got to see a red sweep. You combo that, that's something that's a backdrop that's very, very bullish for tech investors.
There's been some comments from Trump and from Vice President-elect J.D. Vance, negative towards maybe some social media and tech in general. How do you take that into account?
Yeah, I mean, look, they're not fans of Google, Meta. The irony is you look at TikTok, Trump getting in basically means TikTok, they're not going to get banned, and I don't think anything changed from an ownership perspective.
So with President-elect Trump in the White House, what does that mean for TikTok?
So from a Twilight Zone, even though he started to get the actual looking to get TikTok banned, here we are, 180, it's the opposite. Actually not supporting a TikTok ban. So now TikTok doesn't get banned. Now part of that is because Trump is very negative toward Google, Meta. So when you think about it from a tech perspective, and you saw it a little in the stocks yesterday, I'd expect them a little 12-round battle that they'll be going through with Trump in terms of some of the issues around, what we see on social media, Section 230, which has obviously been the shield.
And what is Section 230?
So Section 230 is really what shields social media companies legally, and that's been a big contentious issue. The view is if Trump comes in, what happens to Section 230? I don't think anything happens per se, but when you look at some of the risk, quote unquote, in terms of big tech, definitely on social media, and then clearly on the China issue in terms of he'll be a lot harsher on tariffs, but now the difference is who's to his right as the whisper? It's Musk. So Musk is going to be able, I think, and the view is on the street, navigate these issues when it comes to China, tariffs, AI, with now being the sort of whisper.
Well, if you're an investor in NVIDIA, for instance, how do you view this?
The way you view this is that even though initially you'd say maybe negative on China tariffs and what that could do for Godfather of AI, Jensen, NVIDIA, the reality is that with Musk in there, cooler hand will ultimately prevail. I don't really see any major risk from an NVIDIA perspective. To some extent, maybe more of those chips going toward U.S. instead of China, which is ultimately just bullish for big tech. That's why any which way you kind of take this, it's bullish U.S. tech, bearish China tech. But the Musk and just him being integral in 1600 Pennsylvania Avenue is very important in terms of the view in the tech trade. It's not some 202 bureaucrat that's ultimately grandstanding trying to get through some tariffs. Now you got Musk that has, I think, best pulse in terms of what's going on in broader tech and AI.
So you seem to think that Elon Musk is going to play a active role in this Trump administration?
He is going to play a significant role. Now, unofficial. Now, is he going to be a cabinet? No, because then that's very complicated in terms of his ownership and what he'd have to do for his stock. But he's essentially going to be, call it AI ambassador, call it unofficial cabinet whisperer. Musk will have a very important role in this White House, specifically around driving AI. And that's also why, autonomous is going to be front and center, because that's he is very focused on autonomous in terms of potentially Trump accelerating some of those autonomous FSD issues. And that is key to the stock because we believe that's worth $1 trillion alone in terms of the AI autonomous story.
Just a broader question for you. Can tech satisfy the market expectations?
I think, and we've talked about it on the show, I mean, demand to supply is still 15-1. So a lot of the bears in their spreadsheets, 10th floor New York City office building, they can see AI in those spreadsheets. I think numbers go up across the board, 10, 15% going into next year. And our view is it's Goldilocks. Fed's going to cut 100, 150 bips. You still have $6 trillion on sidelines. And we are talking about an AI revolution. It is still, call it 9:30 p.m. in the AI party that goes to 4 a.m.
Best pick right here, Dan, 30 seconds.
The Messi of AI, Palantir.
Boy, they crushed it on the earnings.
And again, when you look use cases, Palantirs, they're in that Mount Rushmore, of course, with Jensen, with Microsoft, with what we names like ServiceNow as well. Palantir driving it from a use case perspective, and still many institutions, I mean, very negative on Palantir. I love the setup of the story over the coming years.
Did Jimmy Buffett will that shirt to you, by the way?
Again, he did, and the thing is, this was a shirt I was actually going to give to Keen. But he actually said it was a little too
and after
sort of
Labor
subtle.
Day, John, I don't think you can go. You can't go out like this after Labor Day. But Dan Ives can
pull
it off.
Can.
He can pull it off. Dan Ives, managing director, senior equity analyst at Wedbush Securities, joining us here in our Bloomberg Interactive broker studio.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Matt Miller sitting in for Alex Steele here in this hour. We appreciate that. I'm Paul Sweeney. We're live here in our Bloomberg Interactive broker studio. We're streaming live on YouTube as well. Matt, I'm not sure if you're aware of my Milwaukee theory. And my Milwaukee theory is pound for pound, some of the best money managers in the world are in Milwaukee. I have no idea why.
I thought you were going to say motorcycles.
No.
Harley Davidson, baby.
Yeah, I know the HOG, H-O-G. I don't know what's going on out there. Maybe it's the University of Wisconsin. But one of those folks joins us right now. Janet Rilling, Senior Portfolio Manager and Head of Plus Fixed Income at Allspring Global Investments. Maybe because Ann Milletti was one of my first clients, and she's one of the smartest folks. Bloomberg Interactive Broker Studios, where Janet finds herself. Janet, today versus maybe a couple of days ago, has your view of the bond market, the treasury market, the Federal Reserve, has that changed given what's happened politically here in this country in the past couple of days?
Well, we do have new information, and we can remove some scenarios off the table because we do know some things about what our government's going to look like in 2025. When it comes to the Fed, however, I think the Fed is on the same path. They are looking to get off of restrictive level of rates. The expectation, of course, today is that 25 basis point rate cut. And I think as they look forward, they're going to continue to want to move in that direction. But they, too, now have more information, though still not enough to really know what policies will be implemented. So I think they're going to be cautious in terms of how they interpret the election results. But they are certainly aware of them. And I think down the road, that is going to influence their path.
Yeah, we had priced in about 170 basis points of cuts for next year, for 2025. And right now, the terminal with the WIRP function is showing only about 80 basis points of cuts for next year. So the market has moved substantially in terms of pricing. Obviously, you can see it in the long end, well, across the curve, but especially on the long end as well, of the Treasury yields. Do you think that we turn that around? Is that just a knee-jerk reaction to Donald Trump, winning the presidency? Is it possible that rates on the 10-year go back under 4, or do you see them headed back towards 5?
I do think it's possible that they move back under 4. We did learn with this change in government that, we'll probably have a pretty supportive fiscal outlook for growth. So that's something that will keep things growing. On the other hand, the prospect of tariffs leads to potentially more upward pricing pressure. So with that in place, I mean, it's a balance. The tariffs will take quite some time to, first of all, get in place if the policy is successful, and then to work its way through the economy. In the meantime, I think there is the opportunity for rates to start coming back down after people have digested all of the information. Inflation, though, it does still need to be top of mind. It is not at the Fed's target. It's been moving in the right direction, but it's been sticky, and that is going to be a focus for the bond market. And certainly if the bond market is of the view that we're going to continue to grow the deficit, that's going to weigh on rates. And so it's probably more likely it will be in this range, but I do think it's possible we can go back below 4.
All right, so given that backdrop, do I just sit in my 2-year Treasury and get 4.2%, or do I take some credit risk out there?
Well, it's certainly tempting to stay at the front end, particularly money markets, right? We know a lot of folks have stayed in money markets.
Yep.
But what we have to remember is those yields will continue to reset lower as the Fed continues to cut rates. And we do think that will persist. The Fed does want to move off of this restrictive level. So to avoid that reinvestment risk, it can make sense to start moving out the curve. And in terms of credit, we do know credit spreads are rich, but the economic outlook is quite good. And so credit spreads could stay narrow for quite some time. So we're not recommending a full overweight in corporate credit, but we do think some allocation there makes sense to get that incremental yield. Stay highly diversified, that's quite important. But if you're just huddled in the front end, you're really positioned for one scenario rather than being diversified for what is likely a wide range of scenarios.
In terms of stocks, we're just 35 points away from S&P 6,000. I mean, it's pretty unbelievable as I look down at my screen and I see 59.66 on the S&P 500 right now. There are very few strategists who even have this as a year-end target, let alone a 2025 target. Do you think we have more room to run here?
Well, again, I think we're setting up for a good growth environment. We have more clarity on tax policy, and from the corporate side, I think that is supportive. It allows companies to make decisions, to invest, to continue to add to capital expenditures to fuel that future growth. So I think that is about a lot of the optimism that's baked in. But we have seen in the past, the knee-jerk reaction after elections, people extrapolating things. It's not going to be totally clear sailing. There's going to be, more talk about what is the tariff policy, what impact will that have, working its way through the supply chain. The input costs could be impacted. Retailers that you have a lot of goods that come from China could impact their margins, or else they have to pass that along to the consumer. So we're going to have to continue to watch how the consumer is doing through all of this. But I think at the outset, certainly having more certainty on tax policy and decision-making by corporate America is helpful.
In the fixed income world, what is a structured product, or what are structured products? Because a lot of people tell me that's where I need to look. How do you guys think about that?
Well, first of all, we would agree. We think that's a good place to look. We think
so is that
there's
like
value
mortgage-backed
there.
securities, asset-backed securities, that kind of thing?
Yeah, it's really
Okay.
a range of securities. So agency mortgage-backed securities is the largest part of that market, but ABS, or asset-backed securities, which actually has a wide range of exposures. I mean, it can be consumer, like credit cards. It can be auto exposures, but also some company exposures. Franchise deals, like Five Guys is an example of a franchise deal. So it's
Love Five Guys.
Delicious. Delicious.
Yeah, so that's a way you could get exposure to that. Very diversified exposures there. That's part of our view of what the appeal is to structured product, and a very important part of the investment grade part of the fixed income market.
So you're not talking like buffer products. You're not talking like, capped gains and protection against losses when you talk about structured
No, thinking
products.
about cash flow streams that are packaged in a way that focus on different parts of the market. So, a pool of credit card balances would be one example of ABS. There's other exposures too. Commercial mortgage-backed securities is another segment of structured product. Certainly an area where like office properties have been under pressure, but it's a very wide space, and so there are things beyond commercial or office properties, things like leisure, retail, and many of those properties are doing quite well. So that's another avenue for
Medical,
structured product.
student housing, adult living or senior living facilities.
living.
Why are you looking at me? Why are you looking at me? U.S. versus non-U.S. What do you guys at Allspring do?
We do both.
Okay.
We think that being diversified globally makes a lot of sense. European credit, for example, is an interesting area. You can look at valuation there compared to the U.S. Currently, it slightly tilts in the favor of European credit, and it's a way to just diversify your portfolio a bit more. We like the triple B area of European credit, and then that higher rung in high yield, the double B.
All right, good stuff. Janet, thanks so much for joining. You're based in I can't pronounce this, and I've been doing it for 40 years. Menominee Falls.
Menominee Falls.
Right, and that was originally Dick Strong Asset Management. We're out there. And I think he just went to University of Wisconsin, picked out like the best students every year.
I mean, I've heard your Milwaukee theory before.
Yes, and and downtown Milwaukee, there's some old crusty little firms down there that have been managing little money you'd never heard of, but they've been doing it for like generations. I don't know what's going on out there, but
it sounds fantastic to me. I love Laverne and Shirley.
Yeah, who doesn't?
But didn't Donald Trump say it wasn't a very nice place to?
I don't know.
Wasn't he? He used a more colorful term.
I thought that was Detroit. Or is that
Milwaukee? That too.
It could have been as well. All right. Janet Rilling, Senior Portfolio Manager and Head of Plus Fixed Income, Allspring Global Investments in the greater Milwaukee area. We'll call it that, but she's here in our New York Interactive Broker Studio, coming to New York because it is the world capital, of course.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
John Tucker sitting in for Alex Steele. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Brokers studio. We're also streaming live on YouTube. In a few minutes, we're going to check in with Allison Williams. She covers the big banks for Bloomberg Intelligence. And what blew me away yesterday, John, was the move in the banks. You had companies, a gajillion dollars of market cap, like J.P. Morgan, Goldman Sachs, up 10, 11, 12%.
Most of this is based on what they think is going to be the new regulatory regime, or a lack thereof.
Lack thereof, I think, is how I understand it. This Basel Endgame, Basel III. These are global rules for banking that were enacted after the great financial crisis. And yes.
How do you get rid of global rules, or you just ignore them? Well,
we basically, I think, are just going to kind of ignore them. But I think that's kind of the deal. But I mean, it just means greater profitability potentially for some of the big banks in the U.S. And we saw just huge moves here. So we wanted to figure out what's going on. Allison Williams can help us there. Allison Williams, she's a senior analyst. She covers all the big global investment banks for Bloomberg Intelligence. Allison, why did the banks rally so much yesterday on the news of Donald Trump becoming the president-elect?
So we see three things. So the big one is less regulation. Secondly, higher interest rates. And then third, we really see some momentum for fee revenue, which has really been powering the big banks that I cover. So the regulation is the big one. And it's not just some of the specific issues for the banks as a whole and one or two banks, but it is just, the feeling that the pendulum can swing the other way, right? So that there won't be new regulations and that some of the things that are sort of in the pipeline could be watered down or pushed out. So you were just speaking about Basel III. So that Basel III endgame has been the big one for the largest banks. And, Basel dictates that all jurisdictions around the world have to do some form of implementation. But the U.S. proposal that came out in 2023 was really much stricter than we saw in other regions. We had already had some expectations that would be watered down from comments that Powell had made and also comments from Barr in September. So some of that was sort of in the stocks, but I think the feeling is, from our regulatory group, that the things could either get pushed further out or they could be watered down even further. And so that's good for the banks because their excess capital is something like 5 to 15% of their market caps. So definitely that was something aiding Citigroup and Wells Fargo, as well as someone like Morgan Stanley and Goldman, where even with the sort of lighter touch in September, they were still going to have a deficit in their capital. So some positive news on that front. Also, as Wells Fargo has had this asset cap for a long time. Citigroup, there's been some concerns, especially around when they reported their results, that they could face more scrutiny. So just a particular easing, I think, also benefited those couple of banks. And then there are some other things related to card and consumer finance as well. On the interest rate fronts, all these banks are positioned for higher rates. Yeah. So we know that we'll be watching the Fed in terms of short-term rates, but I think in general that also got a lift. And then finally, from our viewpoint, the big thing is that we see momentum in fees, and that's been a huge boost to the earnings for these banks.
Just back to the Basel III endgame rules, the idea is, give me the dummies version. You had to set aside more capital, basically, in case things went south, so the financial institutions wouldn't ruin the economy, right? So that's right, freed up. Does that now go back to shareholders? Is that the idea?
That is the idea. And so Basel III endgame rules, so as you know, Basel III is something that sort of came after the financial crisis, and there's been many iterations, thus the reference to this last set of rules as endgame. And basically what that dictated was that as they measure their risk-weighted assets, there would be big increases in that, and thus they'd be having to hold more capital against that. And so based on third quarter earnings and fourth quarter requirements, their excess capital was 5 to 15% of their market cap. Under the Basel III rules, that would turn to deficits across the bank. So they would have to find a way to increase their capital. There is a timeline, so they probably would have done that through internal capital generation. But to your point, that would have been capital that they could not return to shareholders.
Can I just ask you, who has the most capital to be returned to shareholders?
Well, based on the requirements today, Citigroup, their excess capital is something like 15% of their market cap.
Okay, all right. And
I would point out also that these banks have and so by the way, like the banks do sort of target holding a buffer to the requirements, so there's a little bit of that. But I think in general, it is the fact that buybacks will likely go up. These banks already have buyback programs in place, so they can execute on them. But it's also the math. If you have higher equity, your return on equity is going to be lower, and that's how investors value stocks. So there is definitely the higher buybacks, but also I think it is the sentiment that is helping bank multiples, this specific regulation, but also less regulation in general. One other area I didn't talk about with regard to regulation is less antitrust. So that's good for M&A. And that's really why you saw Goldman and Morgan Stanley the stocks reacting to that.
Allison, thanks so much for joining us. Allison Williams, senior analyst covering the global banks around the world for Bloomberg Intelligence. She's based down in our Princeton office. Again, the banks had a big move higher yesterday that really got people's attention, thinking that there will be a better regulatory place under a Trump administration.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.